Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. I am your host, Dan Sipe. And additionally, as you already know, I'm the branch manager here at Serving Sipe Associates. I begin, as I always do, with saying thank you. Thank you for taking the time to listen, because I know it does take time to do this. Although I think we're getting back to commutes now, so hopefully I'm giving you something that you can listen to on your commute. But also, I want to say thank you for your service. We thank so many people, and as far as I'm concerned, we always forget to thank the civilian feds. That's never going to happen here. You will always hear it here. I always remind people, I nag people to remember that you folks are the glue that holds everything together. And another person that we can always count on is the guru, Ed Zurndorfer. He is back with us again as part of our ongoing mission to reach, teach, and serve you. And at the outset, I need to say the opinions of our guest, Ed Zurndorfer, are not the opinions of Raymond James and Serving Those Who Serve. This podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you do not have a personal advisor, hit us up at stwserve.com. We'll talk it through with you. Maybe you want to talk to us, maybe you won't, but either way, we will talk to you and help any way we can. And we are back on the continuing topic, the number 2 favorite after when can I retire? TSP, Thrift Savings Plan. You put it in all those years, how do you take it out? And folks, be sure to read Ed's FedZone articles because there are a ton of helpful tables in there. So seriously, right now, unless you're driving, go to fed-zone.com. Type in TSP. You're going to see the whole series. It's a series of 4. He's covering all the different types. And what we really can't do on a podcast is talk about the visuals. And Ed has said one of his pet peeves is that TSP doesn't give you examples of how things are going to look. Ed always does. So be sure to go there and do that. So Ed, in our last podcast, we established you're pretty familiar with TSP, right?
Yes, both contributing to it. I have a TSP account and investing in it and talking about the various withdrawal options. I've did many webinars, seminars on the TSP. We have at Serving Those Who Serve a webinar on the TSP every month, Dan, as we mentioned.
Do we? Wow, I can't believe that worked in. So enough of my shameless pandering and plugs here. Let's get to the stuff that the folks are wanting to hear about. So we're picking up on your second article of the topic that talks about single withdrawals and transfers to qualified retirement accounts and IRAs. So once again, some of my questions, I'll slip them in here because they actually reference your 4th article in the series, which talks about tax treatment. So I'll try and fit those in where appropriate. So tell us a little bit about single withdrawals. What are the rules?
Okay, Jan, single withdrawals. So in a separated, we talked about what a separated TSP participant is someone who's either retired or left federal service or who has what's called a civilian TSP account, or if you were a member of the Uniformed Services, you were able to contribute to your TSP account while you were in the Uniformed Services, but you have either retired or left the Uniformed Services, you are what is called a separated TSP participant. And the other type of TSP participant is called a spousal beneficiary. A spousal beneficiary. If you are you are a spouse of a deceased TSP participant and you have the TSP account, you have the option of keeping your inherited TSP account that you received from your deceased spouse in the TSP in your name. It's called a spousal beneficiary TSP account. And you have the same options as a separated TSP participant in terms of withdrawing the money, one of which is what's called single withdrawals, and in which you can request from TSP single or partial, you're not taking out the whole thing, a withdrawal from your TSP account of at least $1,000. $1,000 is a single payment. For example, You haven't done anything with your TSP account. You retired, you just left it alone. Like I have, I retired 15 and a half years ago, haven't touched my TSP account because I've had no need to. Let's say I have to go out and buy another car. Got to make a down payment. I could contact the TSP at this point and say, I need a check for $3,000 from my TSP account. And that's just a one-time payment for right now. It's a single withdrawal. They'll take out federal taxes. I make the payment. Then I'm good to go, get the payment. And if I have to make another single withdrawal, I can in the future.
Okay.
It used to be until the year 2019 that when you made one single withdrawal, again, of at least $1,000, you could not make another one. That's it. They only allowed it one time. Well, they changed that. Now you can make multiple single withdrawal requests.
Okay.
At no more than every 30 days if you have retired. So that's roughly about no more than 12 per year. And very interesting that if you are a federal employee and you are age 59 and a half or older, you can make what's called an age-based withdrawal. Here, you're still contributing to the TSP. You're still in federal service. And maybe you have a sudden emergency and you'd like to take money out of your TSP account. You'll be allowed to do that because you're over 59 and a half. In that case, you can make no more than 4 such single withdrawals per year from your TSP account.
Gotcha. Now, if we're going to do that, probably tax considerations we should be thinking about, right?
Yes, there are tax consequences. But before we get into those tax consequences, I just want to mention that there are 2 types of TSP accounts. You have a traditional TSP account. And when I say traditional, we're going back to the original TSP, which started approximately 1987, in which the contributions to the traditional TSP are coming from an employee's or uniform services gross salary before it's taxed.
Gotcha.
If you're earning $80,000 a year and you're putting $10,000 into the traditional TSP, your taxable salary is reduced to $70,000.
Yep.
So in other words, that $10,000 has never been taxed, federal or state.
Gotcha.
It goes into the TSP account. You get earnings, interest, or dividends, capital gains, which also are not taxed until they are withdrawn. So what I'm saying, Dan, is that all withdrawals from the traditional TSP are fully federal. And if you live in a state that has a state and perhaps maybe a local income tax, but at least a state income tax, there are 42 of such states, then the withdrawals from your traditional TSP are also state taxable.
Gotcha. But for Roth?
But the other type account, Dan, is called the Roth TSP.
Yep.
The Roth TSP started in 2012, in which the employees have the option of contributing to the Roth TSP together with their traditional TSP. Their total contributions to both cannot exceed the limit for each year. But when they contribute to the Roth TSP, the money that's being contributed to the Roth TSP is coming from their after-tax salary. After the federal taxes are taken out, after the state income taxes are taken out, then the net after-tax payments can be contributed to the Roth TSP. So the contributions are after-tax dollars. Again, you're getting earnings on the Roth TSP account, interest, dividends, capital gains, so that when money is withdrawn from the Roth TSP, will taxes have to be paid? Well, we know that the contributions you put in there have already been taxed. They certainly would not be taxed again because they've already been taxed.
Correct.
What about the earnings? This gets a little tricky.
Yep.
And here's the rule. When you take money out of the Roth TSP, in order to not pay tax on the earnings, you must fulfill 2 requirements. Number 1, you have to be at least age 59 and a half, or if you're disabled,
Gotcha.
you have to be at least put aside disabled. You're at least age 59 and a half. And 2, it has been at least 5 years since January 1st of the year that you made your very first Roth TSP contribution.
Gotcha.
It has to be at least 5 years since that January 1st. So, Dan, I like to use an example here.
Okay.
Make things a little clearer. Again, I like to learn by example.
Mm-hmm.
So I have a few individuals who told me they intend to retire this coming December 31st, 2021.
Gotcha.
One individual approached me, told me he's going to be 60 years old when he retires on December 31st, 2021. He has 20 years of service, so he's eligible to retire. He has the years of service and he has the minimum age, 60. And he told me he has both a traditional TSP account and he has a Roth TSP account. He has contributed to both.
Mm-hmm.
So he asked me the question, what is the earliest date I can start taking money out of my Roth account and not have to pay tax on the earnings? So I asked him, when did you make your first Roth TSP contribution? He told me on July 15th, 2018. He waited a little bit before he started putting money in the Roth TSP.
Gotcha.
He said he'd like to start taking money out of his TSP account after 30 days, starting in February 2022. So I said to him, first name is Mike, you better specify to the TSP that you only want to take the money out of your traditional TSP account. And you can do that. I'll talk more about that in a moment. Because you have to specify to the TSP which TSP account you want the money to come from.
Right.
And he said, why do I have to specify traditional? Because he said, I'm going to have to pay tax on that whole thing. I said, I realize that.
Yep.
But if you took money out of the Roth TSP, you'd have to pay tax on the earnings. He said, why? Mm-hmm. I said, well, I know you're going to be over age 59 and a half, but let's go back to the year you made your very first Roth TSP contribution. That was on July 15th, 2018. Now go earlier to January 1st, 2018, and count 5 years. So what does that bring you to? January 1st, 2023.
Yep.
You got to wait those 5 years. If you took money out of the Roth TSP during 2022, you would not have met the 5-year rule. And you know what the TSP is going to do? They're going to tax the earnings on the amount of the money coming from your Roth account. That's why you have to specify that you don't want any Roth TSP money coming out until the earliest January 1st, 2023.
Gotcha.
It's a little sticky.
No, that makes sense. And that's a good tip for everybody to watch. Now, you also, in this, you talk about the prospect from the single transferring from the TSP to something else. And you mentioned that it could be a new employer's program. It could be an IRA. And you advise that Fed should check with the plan of the IRA provider first. Why is that?
Not all qualified retirement plans. I'll give you an example of a qualified retirement plan, a 401k plan, a 403b plan,
yep,
a 457 retirement plan, a Tsp IRA plan,
sure,
a simple IRA plan. Not all plans accept transfers from other retirement plans.
Gotcha.
You have to check with the plan custodian, the administrator of the plan, to see if they'll accept it. Assuming they do, one can transfer all or a part of their traditional TSP account to a traditional IRA or to one of these qualified retirement plans that I mentioned, assuming they accept them.
Yep.
So we're talking about a traditional TSP transfer to an IRA, traditional IRA, or a traditional 401k plan. I'm emphasizing the word traditionally here, Dan, because if you have a Roth TSP account,
yep,
that can be transferred either to a Roth IRA or to a Roth 401k plan. There are some 401k plans out there that are what they call Roth 401k, like you have the Roth TSP. The same thing is true. We have the Roth TSP.
Yeah, no, I mean, but also our firm has one too. When it became available, we added the Roth option. So you're absolutely correct.
You have the Roth
401ks. Yep.
You have a Roth 401k.
Yep.
There's a Roth 403b plan. There might be a Roth 457 plan.
Sure.
So you have to make sure that we're going from apples to apples here. Roth TSP to either a Roth IRA or to a Roth 401k plan, Roth 403b plan, Roth 57, et cetera, et cetera.
Yes, because you mentioned later in the article that if they can do it, but if somebody wanted to move traditional TSP money out to a Roth IRA, they're going to have a tax consequence.
Yes. Let's think about this, Dan. I think we mentioned either on this podcast or the previous one that everything in the traditional TSP has never been taxed.
Correct. Yep.
We are talking about the employees' contributions that they've made to their traditional TSP via payroll deduction. We're talking about all the earnings in the traditional TSP have never been taxed. We are talking about any matching contributions that a FERS employee receives from his or her agency, as well as the 1% of gross pay automatic contribution that a FERS employee receives from his or her agency. None of that money has ever been taxed.
Yep.
When you transfer all of that pre-tax money to
There's a toll booth.
Roth,
There's a toll booth.
There's a toll booth.
Yep.
The hand is out there.
There it is.
The hand is waiting to be paid.
Yep.
Because you're going from something that never has been taxed, that is traditional money, into a Roth IRA in which all qualified withdrawals from the Roth IRA are not taxable.
Oh, yeah.
The IRS, the state of Maryland, the District of Columbia, the Commonwealth of Virginia are not going to say, oh, we'll just forget about all taxes. We'll just put it into the Roth account. That doesn't happen, Dan.
You're right. You're right.
And I will tell you, I caution people about this because we were talking in our last podcast about these installment payments or fixed payments or payments based on life expectancy. When the TSP pays out in these monthly payments or annual payments directly to you, in the case of the traditional TSP, they do withhold automatically 20% in federal income taxes. You can request more, maybe a little less, but they will withhold because the check is being made out to you. It's a payment.
Yep.
Well, in this case here, when you request that your traditional TSP be transferred to a Roth IRA, the TSP does not, I repeat, does not withhold taxes. You are responsible for paying any federal as well as state income taxes due on that with the transfer to a Roth IRA. So, for example, suppose, Dan, you decide, hey, I'd like to transfer $50,000 of my traditional TSP to a Roth IRA. And let's suppose you are in a 22% federal income tax bracket. 22% of $50,000 is $11,000. You owe IRS $11,000.
Yep. That
the TSP, again, is not going to withhold. Live in Maryland or the district, that's another 8%. 8% of $50,000 is $4,000 that you are responsible for paying. You better have the liquid assets, a certain amount of liquid assets to pay those taxes due. And furthermore, you better meet with your favorite accountant, tax accountant, who will explain, because you cannot wait to the end in April 15th to pay those taxes. You're going to be subject to an underwithholding penalty. You really have to pay what's called quarterly estimated taxes. I caution people about this. It doesn't stop there, though, because you have to realize that I said you are in a 22% federal tax bracket. But when you add the $50,000, then they push you into a 24% bracket. So now we owe how much now? That's about $12,000.
Yep.
You owe another $2,000 more in federal taxes, plus again state. We talk about this.
Do not try this on your own, folks. Do not try it on your own.
Please. We discussed this during our TSP webinar. I got to make another plug. Our next TSP webinar will be on August 19th. If you have never attended a TSP webinar, please, we have them every month. We talk about these transfers of traditional TSP to a Roth IRA.
Absolutely. And it is complex. So let's stay on the complex thought, because this next topic that you write about, I consider to be one of the most complex and most misunderstood, which is opting for a TSP annuity. Now, this differs from the life expectancy payouts. This is an annuity, and we're going to talk about the difference there. But you begin your article by making sure that people understand this is different from their CSRS or FERS pension if they do this. So why don't you briefly touch on that?
Yes, this is very important to understand that the TSP annuity is not the same thing as a CSRS or FERS annuity. A TSP life annuity, I should say, is not like your TSP account. We were talking about the withdrawal options. You take the money out, the fixed payments, you specify how much you want to come out. It's your call. You can change those amounts from year to year, quarter to quarter. It's not like a CD or a brokerage account. When you buy a TSP life annuity, you are giving up total control of your TSP account. In this case here, your TSP account, you specify the amount you want to give up. And it's actually being taken over by a company called Metropolitan Life Insurance Company. They own these TSP annuities.
Yep.
With a CSRS annuity, if you're a CSRS employee, you're a FERS employee, you work a certain number of years, and then when you retire, you're going to get this guaranteed pension check in the form of a CSRS annuity if you're CSRS or CSRS offset, or a FERS annuity if you're a FERS employee. And that annuity is based on your years of service, your high 3 average salary. It's guaranteed. All that's going to happen is you're going to get paid every month, every year for the rest of your life. What you're going to get, for starters, is based on the number of years of service, your high 3 average salary. You get cost of living adjustments in most years with your CSRS or FERS annuity. But with the TSP life annuity, you are basically on your own with Metropolitan Life Insurance Company.
Gotcha.
In a way, this is a little scary. And the reason I say that, you're giving up control, Dan, is that when you see what you get with this TSP life annuity and you don't like it, you can't do anything about it. You can't say, I've changed my mind. Here's the money back. I'd like to start over again. You can't do that. You're locked in. That's it. So we need to differentiate definitely between this guaranteed pension you're getting in the form of a CSRS annuity, a FERS annuity, versus the TSP life annuity. And I would caution our listeners, our readers, that before you purchase a TSP life annuity, please understand what you're buying. You should really, really know all the ins and outs of this annuity. And this is what I tried to do in this column, which is my third column. It's dated July, I think it's July 20th. We put it out last week. And it talks about all the aspects of the TSP annuity.
And there's a lot to consider with that. But so that we sort of stay on our informational side here, and I couldn't agree with you more, Ed. People need to think long and hard before they give up control over that large a sum of money. But you mentioned, for example, there's a calculator on the TSP website that can help illustrate what it would look like. So let's say that somebody's done their full due diligence and exhaustively looked at the pros and cons, but they do decide the TSP annuity is in their best interest. How do they go about doing it?
Well, if they go to the TSP website, if you are a TSP participant, you have an account. And if you go to www.tsp.gov, and on that website, click where it says Withdrawals and Changes to Installment Payments, there is, and then you go and you're in your account, My Account section. There is an online tool that is used for requesting any type of TSP withdrawals, including purchasing a TSP annuity. Again, it's under your account. You got to click on where it says Withdrawals and Changes to Installment Payments. And the online tool there will walk you through requesting any type of TSP withdrawals, including the installment payments, the single withdrawals, everything we were talking about, and also purchasing a TSP annuity.
Gotcha. And let's talk a little bit at a high level of sort of the general flavors of this. From my experience with annuities, there are single life options, which basically mean it's providing an income for the person themselves, the employee themselves. They die, it stops. But there are also some that can provide some benefits to heirs. Why don't you talk about that a little bit?
Okay, so let's go to the basic TSP annuity. It's called the life annuity, in which the participant requests to buy an annuity. Minimum purchase is $3,500, Dan. The minimum purchase is $3,500.
Gotcha.
To purchase an annuity. And they want to buy what is called a single life annuity with no bells or whistles. This is the annuity that has no bells or whistles. I'll explain what bells and whistles include here in a moment. In which whatever amount they're going to turn over to Metropolitan, whatever amount, that amount is turned around and is given to Metropolitan, and Metropolitan turns around and gives this TSP annuitant, I call it, income for life, a monthly payment that will go on forever. Now, we know that the stock market goes up and the stock market goes down.
Yep.
Let's say we have an individual, his name is Sheldon.
Okay.
He wants to purchase an annuity of $100,000. And what Sheldon's going to say is, I want to take $100,000 of my TSP account, turn it over to Metropolitan Life Insurance Company, and Sheldon has all of his money in that account invested in the C fund, the S fund, and the I fund, the three stock funds. Now, we know that over the past year or two, the stock market has gone gangbusters.
Yes.
Sheldon's account has grown enormously. But we all know when the stock market goes up, the stock market does go down.
Yeah. And
we've had some bad years like 2008 to 2010. And Sheldon is very concerned that when he turns over that $100,000 to Metropolitan, that the value of that $100,000 he's turning over may go down some years, might go down to $90,000. So does that mean Sheldon's going to end up getting less income? And the answer is no.
Nope.
Because no matter what happens to the stock market, if Sheldon had money in the F fund, the fixed income bond fund, invested in bonds, if interest rates go up, bond prices go down. That's a rule. So would the value of his TSP account invested in the F fund go down if he turns it over to Metropolitan? No. Metropolitan says, it makes no difference, Sheldon. No matter what happens to the bond market, no matter what happens to the stock market, you're giving us $100,000 and we, in turn, will pay you for life. That's what a life annuity is.
Yep.
Now, what are Sheldon's monthly payments going to be based on? Number one, Sheldon's age at the time he purchases the annuity.
Gotcha.
The older Sheldon is, the more will be his monthly payments. Why? Because he has a shorter time to die if he's older. Also, Metropolitan pays interest in that account, within the account, to make it grow a little bit. That interest rate is basically based on the G fund at the time, the government securities fund at the time of purchase. So let's say Sheldon is 65 years old when he purchases this TSP life annuity. And the interest rate is G fund is 2%. The TSP on its website has an annuity calculator. And based on Sheldon's age, 65, and the 2% interest rate, Sheldon is going to get $1,000 a month, guaranteed, for the rest of his life.
Gotcha.
Again, it makes no difference what's happening on the outside here. The stock market, the bond market, it makes no difference. Metropolitan is guaranteeing $1,000 a month. And Sheldon's very happy about that. He doesn't have to worry if the market goes down.
Yep.
Well, let's realize something. if Sheldon's 65, getting $1,000 a month, Sheldon's going to get $1,000 a month when he's 75.
Mm-hmm.
He's going to get $1,000 a month when he's 85 and when he's 95.
Yep.
We do have inflation now.
Yes, we do.
And the value of those payments, $1,000, may go down. And Sheldon says to Metropolitan, before I purchase an annuity, is there anything I can do to make sure that I'm keeping up with the cost of living? Metropolitan said, yes, we have another option for you.
Mm-hmm.
It's called CPI, called a cost of living adjustment. You can get a cost of living adjustment to that annuity in which every year your annuity go up by 2% per year.
Gotcha.
So Sheldon says, I like that, but I hate to ask this question. Do I have to pay for that?
Oh,
Metropolitan
yes.
says, not directly. But we said we'd give you $1,000 a month in what's called a pure life annuity.
Mm-hmm.
But if you want to get this cost of living adjustment of 2%, your starting payments will be $800 a month. And then next January, the first anniversary date of this annuity, you'll get 2% more. So 2% of 800 is $816, and we'll do that every year. I said, well, that's good. But I have another question, Sheldon says. I know you're going to give me the $800 a month payment tied to this 2% annual increase every year.
Mm-hmm.
But what happens if I die before I get all my $100,000 I put into this annuity? Suppose I die 10 years from now. I got about, let's say, 10,000 or so of payments, but there's still 90,000 left over.
Right.
Metropolitan's going to say, we keep that money.
Ooh.
Sheldon says, we keep that money. You keep it? This was my money. Yeah, it is your money. But when you turn it over to us, it is our money. Is there any way I can name a beneficiary of my TSP annuity?
Sure, Sheldon.
Metropolitan says, sure, Sheldon. You can do that. You can get what's called the cash refund option, in which you name a designated beneficiary of your TSP annuity so that when you die, anything left over will go to that designated beneficiary. It's called the cash refund option. Sheldon said, I hate to ask this question. Is that going to cost me anything? Metropolitan said, you know the answer to that question. Of course it is. Do I pay that fee up front? No. We just lower your payments. To what? To $500 a month.
Ouch.
Dan, Sheldon has lost $500 a month from a pure life-only annuity. Here's my point. The more bells and whistles you add to these annuities, the less is going to be your monthly payments.
And that's a great point. And I know we're not talking about it here, but folks, if you're listening to this and you're out in the federal space, you're going to hear the word annuity come up a lot. And you're going to hear people proposing annuities as alternatives to the Thrift Savings Plan and things like that. I'm not going to say here good, bad, or indifferent, but what I am going to tell you, and Ed has done a brilliant job of helping everybody understand it, they all cost something. There are no free lunches that go with these types of products. I have no beef with the insurance industry. They perform an incredibly important function in our society and our economy, but they're there to make a living. They're there to make money. So when you start looking at things, understand there will always be costs. Some of them are direct, some of them are indirect, but those are great examples, Ed.
Thank you. And in this column, I point out all the bells and whistles, I call them, associated with TSP annuities, including purchasing a joint annuity with someone like a spouse or a child, including something called 10-year certain, in which Metropolitan says your guaranteed payments for 10 years, if you die during that 10-year period, your designated beneficiary will receive those payments. Let's go back to something we said earlier, and that is there is an annuity calculator on the TSP website.
Yep.
We also mentioned that one of my disappointments when it comes to the TSP, and they have a TSP Annuity publication. But one of my disappointments when it comes to their publications is they don't give you a lot of examples. Some of these publications give you no examples, and that includes the TSP Annuity publication.
Gotcha.
So what I did with my column, again, dated, I think it's dated July 20th.
Yep.
I have a full-blown annuity for someone named John. It's showing what's called a single life annuity for John and a joint life annuity for John, joint life with his spouse. And it shows all the bells and whistles associated, all the possibilities, and what John's monthly payments would be with all the bells and whistles. You can see a whole comparison. I encourage anybody who is considering purchasing a TSP annuity to please read that column where you can see it in plain English. It's so important. I just want to follow up something you just said, Dan.
Got it.
I have a philosophy when people ask me, I don't have a securities license. I don't sell anything. All I try to educate the public in general about financial products. But when people ask me about a certain investment, it could be a stock, it could be a bond, it could be a mutual fund, it could be an annuity, it could be any type of life insurance. My response is, please understand what you're buying.
Absolutely.
Be sure you understand the logistics of what you're buying. Never, never be sold on anything. You should buy it. You're buying it because you know you're convinced it's the best thing for you. Never buy anything you do not understand.
Couldn't agree with you more. Could not agree with you more. And that's a great segue here because, folks, I talk about this a lot, but I can't stress it enough on this one. Go to Ed's articles. Those tables make it so clear. And if you determine that something's in your best interest, when you have all the information, that's all we're looking for here. We just want to make sure everybody at Serving Those Who Serve, we want to make sure that we explain things to people as far as make this decision, this happens, make this decision, that happens. But in this particular case, be sure to go to fed-zone.com, queue up those TSP articles. You can go right to the search box and go TSP, and they'll all come up. And if you go through that and you've still got questions, by golly, every single month there's going to be a TSP webinar. One more plug in here, featuring the guru along with Jen Meyer, Matt Kramer, and they're going to be there for you month after month after month. And I got to throw in one more plug here because Ed understands this and Serving This Serve. We get really geeky for this stuff. We read all the stuff you guys don't have time to read. And so check out Benefits Ben. He's going to be chronicling some of the upcoming changes to TSP as the Modernization Act keeps moving forward. For example, Ed, did you know that per the minutes of the Retirement Thrift Investment Board from last November, that the contract for record keeping was awarded to Accenture, which is a great government contractor. But did you also know that as part of the Accenture award, that they will partner with Alight Solutions as part of record keeping for the TSP, and Accenture and Alight will provide a number of new services to TSP participants with a target date of next year, 2022. And it'll be for TSP participants and beneficiaries, and they will include a mobile phone application, e-signature capability, and a mutual fund window. So be sure to check back with us. We are combing things. We have already found source documents on this, so we're going to be putting them out there because this is a pretty big change. TSP, if this goes through, is about to get a whole lot more complicated. Okay? We're going from glider to helicopter now. And there are a whole lot of moving parts to a helicopter, so you don't want to have to build one yourself, and you definitely don't want to have to try and fly it after you do so. So be sure to check back for those things. And you can count on Ed Zurndorfer, Jen Meyer, Matt Kramer, and us at Serving Those Who Serve to stay on top of that. And who knows, Ed, once we get more data on this, we might even do a webinar on those changes, right?
Absolutely, and I will be doing columns, Dan, when all the details are out from the TSP about all these changes. You know I am going to be writing it up at the Fed Zone when I get all the details.
That's my man. Ed, once again, I have to thank you for all the things that you do. Nobody else is putting this information out there. I'm glad you're doing it with us. Folks, that is a wrap. We are, drumroll, serving those who serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. Remember to share it with friends and strangers. Check us out on Twitter and LinkedIn. Don't forget those live webinars, as if we didn't mention them enough. The guru comes to you as we work to reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all. Be sure to read Ed every month at the Fed Zone. That is fed-zone.com. So I will close out by saying, for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one, because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.